One of the biggest reasons that people are becoming more and more attracted to the infinite banking concept and properly designed whole life insurance is because of the concept of positive arbitrage. A lot of people online talking about how you can earn positive arbitrage, i.e. a positive spread on the loans that you borrow from the policy to create more efficiency in your life. Well, I've done videos on this recently that talk about the fact that there is no positive arbitrage, or while there can be positive arbitrage in whole life insurance, it's not an absolute principle. It's more of a circumstantial thing. In this video, I actually want to show you why, even though when there's not positive arbitrage, there's still what I call positive leverage inside of a whole life insurance contract. And that's a pretty powerful thing. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video, because I got videos like this coming out every single day. Let's get into it. I can't wait to show you what positive leverage is inside of a whole life insurance contract. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and today we are talking about life insurance, whole life insurance, infinite banking, properly designing it, and creating positive leverage in our life utilizing what I consider to be one of the most powerful financial tools on the face of the earth, and certainly in the United States. And so but I guess before I get into it, I want to kind of talk about the elephant in the room. And I'm making this video because of the fact that I've had some feedback. Because people, I guess it was probably a couple months ago, I created a video talking about how positive arbitrage didn't really exist in infinite banking. And while it did exist potentially, that it wasn't an absolute principle with infinite banking in the way that a lot of infinite banking influencers are talking about it. And so as I made this video, people started asking and talking to the people on my team, talking to my agents, and being like, well, if that's not how it works, that's why I was gonna buy it and I don't want it. And it kind of blew my mind, like how misunderstood this whole concept was. Because even though there's not necessarily quote unquote positive arbitrage in the way that most people think about it, I think what happens is people and influencers speak about positive arbitrage because it's the simple way to communicate a concept. It's, to me, the reason I don't go there is because it's kind of just a half-truth, and I hate half-truths. It's one of the reasons I hate IUL, because it's full of half-truths, right? And so talking about positive arbitrage is just kind of misleading. However, there is positive leverage, and you don't need positive arbitrage inside of an infinite banking contract, inside of a properly designed whole life insurance contract, for it to be wildly powerful. So what I've done is I've had the team put together a couple illustrations that are going to be really, really simple, because I want to keep this as straightforward as possible. And I'm going to try to allow you to understand like the breakdown of year by year. When can positive arbitrage start? What is positive leverage inside of a whole life insurance contract? And what does that mean for you in the use case and how you want to utilize it and leverage it in your own life? Because that's really, at the end of the day, what matters most. So let me do this. I'm going to go right up to my board here. Not board. I'm going to go to my monitor, my computer monitor, and let's go through an illustration. So you can see here, just really simple, 35-year-old standard non-tobacco, annual premium, $12,000. $92,000 year one. That means I did an $80,000 front load into the policy, $92,000 going in. You can see there's $85,000 liquid. Now, let's talk about this. If I were to take a loan, I want to do this now. If I were to take a loan, and let's see if I can do this. Hold on a second. I've got to get to the right monitor. If I were to take a loan, let's go there. I got this figured out. If I were to take a loan on this policy, and year one, it was $85K. I'm gonna just slide this over here. $85,000. Let's say I had $85,000 of net cash value, and I wanted to take a loan of $50,000. Now, let's do this different. If I wanted to take a loan of $80,000, right now, this loan is going to be at 5.75%. That's what it's going to be. So if I went down here, let's see what that looks like. I'm going to get my calculator out. Put myself up in the corner here. I'm going to get my calculator out here and let's do some math. So 80,000 times 0.575 is $4,600 is interest, right? So that is what it is. Now, when we look at that, what I want to do is I want to go back to the other thing here and look at this and say, all right, so we're paying $4,600 in interest. Well, like, what is this policy growing by? The annual dividend is only $3,300. So I'm paying more in interest at that point in time than I'm actually earning, right? And so that just doesn't work. The math doesn't work, right? Like, I've got a negative arbitrage. Is that okay? Is that detrimental? No, not necessarily, because there's still good leverage there, right? But if you go into this policy, the reason I have a problem talking about positive arbitrage and not positive leverage is because the concept of positive arbitrage is basically trying to get you to assume that there's a positive spread with every transaction you make, which takes the responsibility off of you for having to manage your loans properly. That misunderstanding can be the difference between wild success and massive calamity, right? Like, so it's not to be underestimated how important understanding that principle is. And so I use that example in the first thing here, and I want to show what this looks like. So as we go through here, and I look through this and I go, all right, well, what are we looking for? I'm paying $12,000 a year. You know, everybody knows I go through this. You know, you could see this is a great policy. You got $12,000 year one or year two in premium, and the policy's grown by $12,717. That's pretty solid stuff, right? But you can still see here, my net cash value amount that's available is at $97,000. So that went up, but there's still a certain element of inefficiency in the policy because I couldn't borrow the $80,000 and still have a bigger dividend and an increase in the ultimate policy, right? Like, so the question is, where does that start to kick in? Well, I think if we come down here, let's look at like year 13. I think that was where I found it. I looked through this a little earlier. If we look at this and we say, all right, what's the net increase in cash value? Where does the efficiency really start from a positive arbitrage perspective? Well, we've got 12,000 plus 9,000 dividends, right? It grows by 21.95 is the increase in net cash value. 12, so that's pretty close. Yeah, that gets 12 plus 9671 is 21,671, and so yeah, this is where it gets better, right here in year 13. This is where the policy becomes wildly efficient, like from a loan perspective. Now, that's where arbitrage can really start to kick in, right? Because most of the fees and expenses and everything in the policy have been taken care of. Now, here's what I want to say to this. You don't solve long-term problems with short-term decisions, right? And so I think a lot of times what happens is people think about, well, I want my liquidity now. I want the arbitrage now. It's not about the individualized transaction. It's about the system in which you implement, right? And so what I want to show here is going through here and showing that I want to show another policy, and I showed a policy loan coming out here, and you can see year 15, I showed a policy loan coming out, right? In this policy loan coming out, you can see that I paid the policy loan coming out, and even with everything said and done, I'm paying $12,000 the next year. Policy is still growing by more than what I'm contributing, and the dividend is higher than what the premium is, and the policy is still growing wildly effectively. The dividend is not impacted negatively. That's the other part about this that's really positive. It's like the dividend is not negatively impacted because it's a non-direct recognition company, and the policy is still going to grow even if I never pay that back, right? Like, it's really powerful stuff. And so what I think is really important, here is to get a concept. And I'm going to do this. I want to go back to the board, bouncing all over the place here, more than normal. I want to go back here and I want to say, all right, positive leverage versus arbitrage. What does that mean? So let's say we did, let's go back to the 80,000. You know what? I'm going to use $100,000 because let's face it, it's easier to deal with that number from a ratio perspective. So let's say we had $100,000, right? So this is the net cash value. And let's say we want to take a loan of $100,000, okay? And we take a loan of $100,000. So we'll go year, and we'll go year one, okay? And so what we have here, I'm gonna just do this. I'm building this as I go here. And let's say we have to pay, and I'm just gonna use round numbers. Let's say we use a 5% interest rate. So the interest rate is 5%. And let's say you're only growing at 5%, okay? The next year, or on the loan, let's say you're paying 6%, okay? A lot of people would say, well, why would I do this? Why would I pay more to borrow my money than I would earn on my money? And the answer is simple versus compound interest, right? Now, once again, because of the fact of this number being what it is, and by the way, this is reality right now. This is why there's not positive arbitrage, but there is positive leverage. And let me explain, because you have positive leverage in the terms that it's an unstructured loan payment. That's leverage, and that's positive for you. That gives you control of your money, right? It's simple versus compound interest. This is the other big thing. Now, that gets misinterpreted a lot as well. This is one of the reasons people get in trouble with this, is that what do we have here? We got $6,000 of loan expenses. We have $5,000 of growth, right? Year one. We're talking year one here, right? So now if I go here and I say, all right, that's year one. Let's draw a line here to create a divide, create some color coordination here. And so what do we have here? Now, we have to pay out of cash flow. We have to manage this 6K because we're going to utilize this ultimately. We're going to utilize this to buy, let's say we utilize it to buy a real estate property. And let's say that it created a 6% cash on cash return. So that should create the 6,000 to maintain this. And boom, you're good. The loan is taken care of. Well, the next year, what do you have? You didn't pay into the principal of the loan. So you still have $100,000 loan. Did we earn positive arbitrage? No. The asset took care of this, and that's okay. But now what do we have over here? We have $105,000, right? Because it grew. So we have $105,000, and what are we earning? We're earning 5% on that. So I don't know, what is that? 105,250? No, wait, no. Yeah, no, I got to do this hard. Sorry. Man, my math sometimes. I go 105,000 times 1.05. It's 110,250. My bad. 110,250. Right, this is year two. Over here, what do we have? $6,000 of expense. Right? Or I shouldn't even do that. It's 5,250. My bad. This is what happens when I wing it. I don't prepare all the time. I'm just kind of doing this off the cuff. And so once again, we're going to have to use this cash flow to pay for this. We manage it. This is year two, right? And that is what it is. But we're going to start the next year with the 110,250. That's where that goes. And then we're going to get into year three, and we still have, because we're managing the interest. If we didn't manage this interest, it's important to understand this 6K would turn this into 106. That 106 would turn into more because the interest would just stack on top of it, but we don't want to do that. So I'm just going to pretend I didn't do that. So what we're going to do is we're going to manage that out of cash flow because we have the real estate, providing us this cash flow. And ultimately, if the real estate is appreciating and you draw up your leases properly, you're going to be able to cash flow more and more and more every single year because you're going to put in cost of living increases into the lease. That's going to help you accelerate this process, but I'm just keeping it really, really simple right now, right? So the next year, what do we have? We have 110,250 times 0.05. You have $5,512. Over here, you got the 100,000 still, right? And you're paying 6K. You're going to manage it from cash flow. It is what it is. And you move forward. remember, this is early in the contract. That's how this is going to work in a whole life policy. So now what do we have? We got plus, oh wait, bang, equals plus 110,250. So now we have 115,762. Remember, we can't solve long-term problems with short-term thinking. So now we are going equals times 0.05. So you have 5788. Obviously, I don't need to keep preaching this. You got the 6K. We're gonna cash flow it right out of this. We're gonna divide this up. I'm gonna keep going down the rabbit hole here. We're gonna do this plus, so 115,762. We're at 121,550, and then your 5. We have equals times 0.05, 6,077. All right, so here's the deal. We got 6K here on the 100. So finally, at year 5, and think about it. We're buying this cash flowing asset that all the while this is appreciating. This asset that we're buying, this real estate property is going to be appreciating in value. We're using the cash flow to manage it. And if we know we're going to buy and hold this asset, and it's going to be an asset that we have for years and years and years, and it's going to give tax benefits and all these different things, appreciation, cash flow, we know from year 6 and beyond, we have guaranteed positive arbitrage. Now, I would also argue that there's a good chance that year 2, 3, 4, you would have more cash flow, and I would take the cash flow, and if the cash flow is more than the 6K, which it most likely is actually right out of the gate, but if it's more than the 6K, you actually pay the principal down even more. So that would even compound this effect, right? And create maybe faster positive arbitrage. But when you do it inside of a system, this is what creates leverage. This isn't positive arbitrage, it's positive leverage. It's the difference when you manage simple versus compound interest on the net cash value, because you're never interrupting, you're never taking money out of your policy. You're simply borrowing against the policy here. You're earning compounding, but you're only earning compounding of that money if you manage and pay the simple interest. If you make these payments and you cross off these expenses, otherwise these will compound and add to all this number every single year, and that will be detrimental, because if over here you're earning 5% and that's compounding, and this is the loan rate's compounding at 6%, well, that's not positive arbitrage. This is why people fail with these concepts, because they don't understand that this is not how it works. If you think about it, stop thinking about it as positive arbitrage, start thinking about it like positive leverage, and you start to realize that when you invest in a system and you implement and execute a system, it takes maybe 5 years. Honestly, it would happen faster than this. I'm using a very simplified, dumbed down version for you to get here as an example. But if you just execute this right out of the gate, and you realize like, hey, I'm in this for the long haul, and you realize that the least efficient time in these policies, I think, and this is the part I want to show now, the least efficient time in these policies is year 1 through 5, right? That is just a fact. You can see I'm putting in 12 and it grows by 11.9, right? You can see finally year 3, it's growing better, which is fantastic, but it's still, it gets more and more efficient as time goes on. You can see because of the cash, because of the dividends, because of the fact that a lot of the insurance costs and charges and admin fees they're very front loaded, right? So when we look at it like that and we know that that's the case, well, the efficiency of the policy is only going to add to the efficiency of what we're doing with our assets and with our investments, right, outside of the policy. And so what I would argue, and what I encourage, I should say, and I do this is my call to action for all infinite banking people, for all influencers out there, for everybody who's utilizing this strategy. Let's stop talking about positive arbitrage inside of these whole life policies and start talking about it as positive leverage. Because when we talk about it as positive leverage, we educate people how it really works. And we don't lead them down a path of misunderstanding how this works and misunderstanding their own behavior in how they behave and act and utilize and leverage the policy, because that can be the difference between wild success and massive calamity. And so that is it. If you have any questions, any comments, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Got them coming out every single day. Till next time, have a blessed, inspirational day. We'll talk soon.